Welcome, everyone, to another exciting episode of the YouTube show and podcast, None of Our Businesses, where we talk about things related to the news, current events in finance, tax, accounting, or maybe none of those things. But what's always being done is discussion from the perspective of accountants. And with me today, well, we've got a treat because besides me, Ty, we've got three other accountants. We've got Tammy Hess.
Hi, everyone.
Charlie Zigmund.
Hi, everybody.
And AJ Wheeler.
How's it going?
All right. Well, what are we going to talk about today? Cannabis buying brewing. What does that mean? The Chrisleys. Bank and tax fraud. Crime did not pay. An update. Twitter's debt versus income woes. What to know about accounting students. And 5 tips for better client onboarding. Okay, well, I'm going to kick it over to Charlie to start us off.
All right, I've got an article we can talk about today from the Globe and Mail. It's called Cannabis Company Tilray to buy Montauk Brewing Company as it seeks to expand its U.S. alcohol division. And so what's going on is kind of like the article says, the title of the article says, Tilray Brands is going to acquire Montauk Brewing. It's a bid to expand its U.S. alcohol division. Montauk Brewing company has more than 6,400 distribution points, and it sells in places like Target, Whole Foods, Trader Joe's, Costco, and Walmart. And so one of the kind of plans is that if cannabis is federally legalized in the U.S., Tilray intends to use the brands to make products with THC, the main ingredient in pot. And so it seems like, on the one hand, a really interesting kind of change up to the market of cannabis to have this alcohol and cannabis potential crossover kind of a thing that hasn't really been a thing so far. But it also seems like a big kind of bet on whether or not federal legalization will happen. And so I kind of want to get your guys' take on whether or not you see marijuana being federally legalized. And if so, if that were to happen, is this going to be the key to establishing market share in that new industry, is buying established brands and building these hybrid companies with existing cannabis companies and existing alcohol brands? What do you guys think?
I guess my first question, I think you might have said it and I missed it, but my first question would be, are they aiming towards putting THC in products? Because the CBD combined with products, I think has been a thing now at this point.
Yeah, it's definitely, they're trying to add THC to alcohol. Basically, alcoholic drinks with THC infusions in them, I think, is the idea.
I see. Yeah. So I guess my other thought, or with that clarification, I should say, my thought would be, is it going to be federally legal? Do we expect THC to be federally legal? I think at this point that's become a political ace card that is being held in certain parties' pockets until they feel like they absolutely need it. And I think that, and namely the Democrats, right? I think that they're probably, but who knows? I mean, the Republican Party has been so kind of strange in the last few years about where it's going, that I wouldn't be surprised if there was some kind of strange alliance between cannabis and some other constituent within the Republican zone that causes that to be a issue on that they want to use on their side. But the conservative, or the main, I guess what I think, kind of shooting it straight down the middle, my view would be that the Democrats hold on to that as a way to jazz a certain group of their constituents. But the reason they haven't really done it is because they take that group for granted already, right? So I think it gets played when this is really a political question. And I think it just gets played when they feel like they need that extra boost from the demographics that would appreciate that, when or if the Democrats feel like they don't already have that demographic nailed, and they could get some kind of extra boost from going down this road. I think that's when they do that, right? And But I think my cynical view is, as long as they think they already have that demographic in the bag, or they're not going to, as long as, or they think, or they don't believe they're going to create a lot of additional voter turnout by doing it, I don't think they do it. So I think that, I think a lot of times people in the industry look at it from a very myopic standpoint of, it just makes sense. It makes good business sense. It makes good sense for the states. It's the arc of history is moving that direction, so we know it's going to happen. But I'd say no. I mean, I don't think the political will to make it happen is just inherently there. I think it is being used as the ace in the hole card, being in people's pockets to play winner if they need it.
Yeah, I agree with you, Ty. And I think that what's interesting, to answer one of your questions, Charlie, is I think that once it does become federally kind of accepted, or, no longer illegal in that sense, we are going to see it open up the markets for everything. You're going to, I think there's a famous commercial where they put the hot sauce, I put that S in everything. I think they may put TCH in everything, and they can sell it in the, at the grocery stores in the open market, or maybe in the liquor stores, or things of that nature. So I do think that it will definitely open up the market. I think the question really, goes back to Ty's kind of question. If it doesn't get passed, then how do you hedge your bets on that? Like, a lot of this stuff does take R&D time and effort, and trying to think about, like, what does that look like when it does is available to the open markets in every single state and supported federally, that you don't want to be behind the curveball and, like, not come up with the R&D to get those things up and ready and available for sale. But at the same time too, if it never passes, then you're kind of investing into R&D that may never come to play. So it's, how do you kind of determine whether or not to really start thinking about this? And you don't want to be too late, but you also don't want to be too early for something that may never come. So I'd be curious to see what happens, and how much effort people are trying to do in some of these R&D kind of efforts.
Yeah, I guess I take a bit of a different stance than what Ty was, kind of speculating there, that, it's really going to be like a political ace card. I think personally, like, there's only 11 states right now that don't have either medical or recreational or both in their states. So you're only talking like 22% of the U.S. doesn't have some kind of law in the books that allows, like, medical or recreational marijuana. I think the real tipping point there is the cash that it's going to bring in from, like, a federal tax perspective. Like, I think as you see that number grow or that number expand, where states are gaining a state tax off of it, and then, like, you're going to have bigger and bigger businesses complaining that they're paying too much tax on a federal level. I think that's going to probably be the tipping point of kind of, political money coming in from these larger conglomerates of in the marijuana industry as it matures, as kind of as a market segment in that. I think maybe that's going to tip it more. I think then maybe just like a political wrangling for votes. Although, that's totally in the realm of possibilities too. But I guess I take more of a cynical view. When the money shows up to support it in campaigning, I think is probably when it's going to tip the point more.
I think that makes a lot of sense. And I think it'd be interesting to kind of see how this all plays out. We'll definitely be keeping an eye on it here on this podcast. Do you have another article we can talk about today, Tammy?
Yeah, I have actually a quick update from a story that we talked about back in June, when Todd and Julie Chrisley were first convicted of bank fraud, conspiracy to commit bank fraud, and conspiracy to defraud the U.S. and tax fraud. So according to Accounting Today, Todd received a prison sentence of 12 years and Julie received a sentence of 7 years. They have also been ordered to pay restitution, which the amount has yet to be determined, but it's soon coming. When they were first convicted, they were facing up to 30 years in prison. And so when we talked about this last June, we were kind of speculating whether or not they were going to get the full 30 or somewhere in between. And it looks like they got a bit less than the 30. I did see that they will be reporting to prison after the new year, and they are still trying to appeal or at least stagger their sentence so they're not in prison at the same time. So my question to you guys is, do you think the sentencing was reasonable, or did their celebrity status impact the outcome in some way?
I mean, I don't know all the facts of the case. I don't know if I can necessarily say, what is reasonable, but I do think their celebrity status plays a big factor in it. And I think it does, tend to lead to more lenient sentences than other people might receive. And so, I can't say with certainty if that's what's happened here, but that seems like it could be likely for sure from my perspective.
I gotta be honest, I don't know if it did play into it. I didn't even know who these people were until the story broke. So, I mean, I don't know if they're on HGTV or just Lifetime or something that I don't watch, but that show doesn't ring in my, like watch list, I guess, so I didn't know who these people were, but I definitely thought, yeah, they're not getting off scot-free when I read it, because part of their, role of crimes there is tax evasion. And, any kind of white collar crime, might be seen as a slap on the wrist unless it's tax evasion. And then usually the IRS hits hard. So I was expecting more time, to be honest with you, when I heard, like you could get up to 30 and this was maybe a chance for somebody to make a real statement, and use their celebrity status as more of like a warning sign to everybody else, like pay your taxes and don't fraud the banks, so I was a little miffed at how they got, just 11 or 12 years out of it, and even the 7 years seemed a little light, considering the charges and the amount of money that was alleged in the lawsuit. So I guess I was a little taken back. I thought maybe they would have got more.
So is the staggering of sentences the intent there because of needing to take care of family for kids and things of that nature?
100%. Yeah. And I think that is the part that seemed a little bit unusual to me, where it's like, okay, I've been convicted. I'm, now facing jail time, but can we negotiate when I go in, so that way essentially and I believe it was Julie that stated in some press release of like, they have children that they need to take care of, and they have an aging mother that they need to take care of. So it would be great that if they could, at least one be like, she serves first and then, gets out after 7 years, and then, he can go in after that, or vice versa, but that someone's there to take care of their children, who, by the way, their children are, I think their youngest is a grandchild that they take care of that is, preteen, but their old, one of the younger children is like 16 or 17. And then of course there is a grandparent that is aging, but it's like, how do you negotiate your timing of your sentencing once you're found guilty? That may be where their celebrity card kind of comes into play, where they can convince a judge to negotiate with them and how they pay for their crimes. But it's kind of an interesting point on that.
It reminds me of the old Dave Chappelle skit, right, where they switch the roles, and like the inner city drug dealer, gets the nice plush white collar crime treatment, and then the white collar crime guy gets treated like he's an inner city drug dealer or something, and they show the hypocrisy behind the two.
Well, and we kind of saw that a couple of years ago when they were doing those school emissions crimes and stuff, where like their or actors and actresses were kind of saying, well, here's when I'll do my time, and it'll be in this particular prison because it's a nicer prison. I think there is this, it's not always the same, because you see a lot of other people, and granted the crimes could be different in those types of situations, but it seems that if you do have the money to have a good legal team that can kind of negotiate where you end up landing is helpful in those situations. But yeah, that part is another kind of just a funny little nuance. But at least I think the moral of the story is, or what I'm kind of at least happy about, is that they did get some jail time, right? I mean, 7 years and up to 12 years for Todd. That's a long time. It's not going to be quite their lifestyle of living in Atlanta. I think now they're in Nashville, but to answer your question, AJ, they're basically a rich Southern family that has been followed around by cameras to show how their Southern life and charm and money has gotten them all, the best of the world, when it was actually done by fraudulent means. So not so good.
Definitely not the prison type.
No.
If he gets through those 7 years.
Yeah.
Well, and word of warning to any criminals listening to the podcast, like, at least file your taxes. They didn't file taxes in 13, 14, 15, or 16. I mean, what could go wrong, right?
Yeah. And your kids are reasons to not commit crimes. They're not reasons for linear sentences. They're reasons for you to avoid the crime in the first place. And so it's just irrelevant once you get to the sentencing stage from my perspective. But I've got kind of another interesting article we can talk about, called from Yahoo Finance. it's called Analysis: Twitter's Massive Revenue Drop Adds to Heavy Debt Burden. And so it just kind of talks through some of the factors and what's going on with Elon Musk buying Twitter. But to me, the whole interesting thing is that, he basically bought Twitter at some price, let's say 44 billion, and it was all on the basis of kind of how that company was operating prior to the time that he bought it. But then as he buys it, a bunch of advertisers choose to leave because ultimately he's, polarizing as a figurehead. And so I think the outcome of what he bought is nothing like what he thought he was buying. And so it's just really interesting to me from the perspective of just kind of seeing that all take place. The article talks about kind of the mechanics of how that's happening, talking about sort of losing more than 4 million a day, has about 1.2 billion in interest payments that are going to occur over the next 12 months. It's been given a junk B- rating by debt analysts. But to me, it's all just a fascinating phenomenon of like how quickly can one politically polarizing figure ruin a company's market cap. Have we ever seen an event like this before in terms of just somebody saying the wrong thing and dropping 22 billion as a result? Anybody?
I have to say, so I guess I take a little bit of a different spin on Elon's Twitter acquisition, and my thought on this, and this where I'm coming from is essentially any marketing is good marketing as long as they spell your name correctly, and all that anybody's been talking about for the last 2 months is Elon and Twitter. And so in my mind, and then the completely intriguing kind of public filleting of like former employees, how employees are being laid off, kind of like his thought on programmers and how much they are and are not doing, his very open kind of tweeting of how much money the company was losing in like food costs for providing lunches when nobody was even at the office. I mean, I think it's really like interesting to kind of pull back the kind of corporate veil, or very often very quiet things that happen behind closed doors in very nitty gritty kind of financial terms of how much people are making and why they were let go, how much is being spent on like food costs and waste, and this really interesting kind of like perfect storm of it being open and people people self-reporting that they got fired and whatnot, versus like the amount of media attention that's coming onto it. And the thing that you're talking about here is advertisements leaving in droves. Now, I do log on to Twitter. It's like watching, like a barroom brawl or something. I find it interesting to watch people kind of go back and forth on different issues. I don't necessarily engage in it, but I think it's kind of fun to watch as like a car crash or something. Like you got to look. But what I do see happening is there are more ads. I'm noticing more ads, and I'm noticing more ads from smaller advertiser types on there. You're not seeing the big Verizon or Sprints or, like USA Insurance or something showing up as advertisements in the feed. What you are seeing is more gadgets and, more like drop shipping kind of advertisers. So I think the advertising dollars are there. It may have just shifted from larger, big, but there's a lot of, may have shifted from more of like the larger players that maybe they had on board before, and journal, and newspapers and that kind of thing. It may have shifted more to what you see on like YouTube and targeted ads, and more in the way of like smaller offerings and smaller kind of trinket type offerings that happen. So I don't necessarily know that market analysts are correct on this. Now, it's very possible, and often I look at like the stock market or these valuation things as having very much a recency bias to them, where, it's kind of like, what have you done for me lately, or what have you turned in the last quarter, versus an arbitrage of how much attention this is grabbing from, the mainstream populace. And I think it's arbitraging a lot from that. And I think it's got a lot of eyes on it. Now, what do you do with it? And I think he, like this thing about buying blue check marks, or, what seems to be smaller advertisers coming in and maybe, more targeted ads, or more, you lost 10 million in ads. Well, maybe you can get, $1 million ad buys. So maybe it's not so much that they're losing this massive amount of revenue over this. Maybe it's more so like we're just not seeing the type of advertising or the type of attention that this is getting that I think could generate revenue. I mean, Elon's famous for buying Tesla and saying he thought it would fail. So, I mean, I don't necessarily know he has lost the trust of people that would really invest or stand behind him from a financial standpoint in that way, because it seems that everything he is involved with has turned into gold. If you look at PayPal when he sold it, and then Tesla, and now, he's entering into Twitter. But I think the jury's still out. This is so new that you're really seeing a shift in how the company was run beforehand with a large teams and such, and then you're looking at a very engineering perspective, I think, that Elon's brought in, where small teams, quick, fast delivery. If you're not contributing to the bottom line and you're not working hard, then you're gone. I think is maybe what we're seeing.
I'll yield my time to AJ's very elaborate answer. I think it's good.
The only thing I'm going to add is that no one should be surprised by the chaos that this is happening, right? Like when we were talking about, will Elon buy Twitter? Will he not buy it? Will he do this? Will he do that? What's going to happen when he does it? Now we're seeing it's chaos, which I think everyone kind of predicted. Now I am a little bit surprised in terms of the people pulling funding and things of that nature, and the amount of quick changes. But Elon, if we could go a whole year without talking about some of his crazy antics or business buying decisions, it would be a wonderful year, but it probably will never happen. So that's all I got to say on that.
All right. I think AJ has the next article. Is that right?
Yeah. So I pulled an article actually from our local society of CPAs, and it's entitled "What Employers Should Understand About Today's Accounting Students." Really, what it's talking about is how firms and different businesses can attract young accounting students or new talent into their firms. And so the author lays out a couple ways to do it. Now, it's a very short article, but I think there's a lot packed in here. So I kind of want to unpack some of that and give everybody a chance to kind of dig their teeth into it and give us our kind of opinions on what you think about it. So the first thing she talks about is career growth and professional learning opportunities. And I was kind of surprised that this would be her first, kind of bullet point here. But essentially, it's like create mentorship programs, offer online certifications and courses, encourage attendance at conferences and seminars. There's some interesting ones here. Train your managers to be coaches. Consider having stay interviews instead of exit interviews. And then provide real-time feedback rather than orchestrated performance reviews. I'll talk about why I think that's maybe interesting, or I'll leave it open for you guys to kind of jump in there. The next one, the one that I probably thought should have been at the top, is competitive compensation. Her kind of like 4 employees bullet points here is think outside the box regarding compensation. When a candidate is weighing their options, this may be what convinces them to choose your offer. But they also, she also gets into like Gen Zers, which is about, as boomer a thing you can say. Anyway, young accounting students are coming out. Also understand that compensation means a lot more than a paycheck. I'm not so sure that that's the case, but I think, at least for me, if you're talking about competitive compensation, it's not just that price per hour that you're getting paid or that salary amount that you're getting paid, but what in addition to that is added to the compensation. I'm talking like PTO, any kind of stipends or healthcare coverage that you would have, adding that in there and giving somebody a realistic idea of what their compensation is, I think is always good. Then they talk about the always important healthy work-life balance. So, again, her bullet point for employers is provide as much flexibility as possible with options for remote or hybrid work. I mean, I think we're getting to a point where if you don't have some kind of option to allow to work from home, especially if someone has the sniffles or something, or even a hybrid schedule that allows people to work from home, it's a cost-saving method, but it also means that you need to trust your employees more and and you don't have the ability to micromanage as much unless you really get big on digital monitoring. And then they talk about a strong company culture. So I thought this was interesting because again, her bullet point for employers is clearly communicate your mission and purpose to potential recruits, and develop pathway opportunities for students from diverse backgrounds. Display positivity, authenticity, and transparency during the recruiting process, and develop a culture of belonging for all employees. And lastly, be charitable. So she kind of has some parting thoughts too of what else employers should know about Gen Z in general, or younger, coming straight out of college, people that are looking to start their careers. They enjoy being independent and getting their work done without relying on others. They also want to feel valued for their ideas and recognized for their contributions. They're intentional about their career choices and ready to move from one employer to another with relative ease. And they want to make a difference in their workplace and in society in general. And the last one is they are visual content connoisseurs. So using short videos on social media, in emails, and on websites is crucial to you reaching and engaging your audience. So I thought this was, I think there's some good points here, but I think there's also some parts that, I have a little bit of a difference with, but I'll allow you guys to kind of, give me your feedback on what you think about what she had what she had proposed here as, like attracting a younger workforce.
I think the bullet points are universal to attracting any human being. I don't think they're actually unique to a younger workforce. I think maybe this kind of discussion gets framed as a younger workforce from the standpoint of this idea that maybe older, more mature, experienced workers have a different expectation set because they came into the business world during a time where there was more scarcity and maybe less job opportunities, and so they were willing to accept more from employers than the younger workforce was. So maybe that's the context of kind of framing this as something that the younger workforce is looking for. But in practice, you're kind of more up to date, experienced workforce is as they're as knowledgeable about the current job market environment as your younger workforce is. So I wouldn't expect that you can get a highly experienced person to put up with a bunch of things that the younger person wouldn't put up with, because that when it gets framed this way, it seems like that's the implication of it, right? That, oh, well, they're young, so they're not gonna put up with the things that maybe the more experienced older person would put up with. I think that's the wrong way of thinking about it. And so I get back to my point that I think these are all things that every human being would want. And I think a lot of these things have become, I think the other thing that, and I don't think she in this article was necessarily making this case, but I think the case that I disagree with as often made in this context is that by handling well these other aspects of somebody's work and career experience, you can get away with paying below market. I don't think that's true. I think that it's a balanced scorecard for most people. And the reality is that most of this is now becoming table stakes. And so, if you're paying at market and you do these other things well, then you're in a good position to hire. If you're paying at market and you don't do these things well, then you may be less competitive. But I don't think it's the case that if you do all of these other things well, provide flexibility and balance and where you can work from and, career development and, show you care, and you do all of those things, I don't think that leads to meaning that you get to pay your workforce dramatically less than market. I don't see that. I think there's enough employers out there that do these things in a reasonable way, and they pay market. So that's what you're competing with as an employer. So I would say to our fellow business operators and those who are running firms and things like that, that the idea that you can use culture as a way to just pay people less, that's not gonna happen. And I'm particularly cynical of that idea in the accounting firm environment. While that may happen maybe in some large companies that have brands and unique cultural experiences that are particularly exciting for some people. Like if you run an athletic brand and you have a campus and, you know, you wear athletic clothes every day, there might be something there that goes along with the idea that maybe you can pay a little less than market across the board, or anything you can imagine that way. But in the accounting firm environment, no way. I mean, I think at TCA, at our firm, we have a pretty good culture, but I hold no
Illusions.
illusions. Thank you for the word. I hold no illusions that culture would make up for paying people less than their market value in today's environment. And I don't think our fellow businesses or entrepreneurs should think in those terms either.
About why that is, because I think you're 100% right, but I just want to say that, like, ultimately it's because that approach doesn't actually solve the things that, if you go to a place because they're laid back, for example, but you can't afford rent because they're paying under market, the laid back atmosphere becomes just made completely irrelevant. And I think that in some high pressure jobs where they try to put situations like that into place, it just doesn't function. It doesn't actually make you any more chill to have a laid back boss if the underlying work is overly stressful, or if other parts of the job make that a non-concern. Sorry, go ahead, Timmy.
Well, I was going to say, I think what this article does bring to light, though, and what I would encourage folks to think about is that there are other things that are outside the compensation that people should consider, or that people are negotiating for when they think about their salary and their compensation, and or if they want to join somewhere. So to Ty's point, yeah, I don't think people are going to really discount their compensation below market for some of these things, but they want their compensation to be at market, and they would like to have some of these other things that are important to them. And I think that's, again, not to echo what Ty was saying, but this is all humans, like a lot of people have evolved in terms of what is important for them to work at a company. And it's not just because they're younger, it may not be because of it could be for a lot of different reasons as to what means more to them when they are investing in their career, or spending time away from their friends and family to work, that they want to make sure it's meaningful in different ways. So whether that's having work-life balance, whether that's having flexible schedules, whether that's having, being charitable, there's all these various different things that I would say all employers need to really evaluate when they are going to market. What are they offering to folks? Because they want to have the competitive and retain talent and attract talent to their company, and they're going to have to do it more than just money. Because said alternatively, if you end up paying way above market and yet it's a crappy culture, or you're working every day of every hour of every day, you may not want to do that either, where it's like the money doesn't become meaningful to you and you're like, I'd rather not be paid $1 million a day for this, because it's impacting my other aspects of my life. So I do think that employers really need to evaluate what is important to the people that they're trying to hire. And not only to, one thing I would always push for, and this is for accounting firms especially, is it's not just about who you're trying to hire, but also as you're trying to retain the current people that you have, that you need to reevaluate what your compensation packages are and how you're keeping the talent, not just attracting the talent. So it's kind of a dual kind of process in my view.
I'd also add here that one of the things that the article doesn't address is the fact, like, none of this can be window dressing, right? You can't talk about having a work-life balance and then not deliver on that. And I think the other part of that is all the things mentioned here takes real investment, and whether that's money or it's time. I mean, just the line about train your managers to be coaches, to do that effectively, you're going to have to put a lot of time and effort and money into allowing your managers to grow if they're not naturally like a coach or a leader,
Well, and to that point, AJ, and I think we talked about this in a different podcast, but not everyone can be an effective coach or mentor, and they should not have to be. So, having it to be where it's like every manager has to be, or we can train them to be a really good coach, it may not happen. And so maybe it's better not to have that person be the manager or a coach of somebody else if they don't have the natural gifts to do that, or they can't learn to have those gifts, or they don't want to. I think that's the other part. There's some people who don't want to do mentoring or training or coaching on that. And then the other thing I was going to say too, I 100% echo on your comment. You can't just say that you offer these things. I know that there was a company once that said, oh, we offer 10 weeks of PTO. And, and then when someone would ask, like, well, how often do employees take that? Oh, they can't, and so it's like, it's not great if it's a benefit that you can't actually utilize or people don't utilize because of XYZ. So it can't be window dressing. To AJ's point, you have to ensure that some of these things that you're implementing are talking to are actually in place and in action.
Yeah. And I think also to your point, Tammy, I think I'm surprised they listed managers, because I think if you have somebody that you can identify as a coach at any level, cultivating that in somebody is really vital, I think, in like passing on that knowledge and in an onboarding process. So I would say, that was one that stuck out to me, that I'm like, wow, no, like you said, not all managers can be coaches. There's a very specific mindset and temperament and, inclination to want to do that and to be able to do that it's a skill set that, I mean, let's be frank, a lot of accountants don't have, you know what I mean? And so if we're talking about the accounting profession, just, in a silo here, I would say a lot of this goes against the grain of what many firms have been in the past. And to make this pivot out of it, that's why I said it can't just be window dressing, because I think a lot of this goes against even what the industry was like 10, 15 years ago. It was very prestigious to work at one of those big four accounting firms. And now I think that it's lost a little bit of that luster. But yeah, Tammy, you have our next article for us.
I do. I found an article from Accounting Today on 5 tips that will lead to better client onboarding. So we talked a little bit about employees and talent. Now we're going to be talking about clients. The article states that onboarding your client correctly could increase retention, productivity, and overall client satisfaction. So the 5 tips are as follows. Ask the right questions at the start. This involves obtaining an understanding of your clients, what their goals are, what their challenges and needs are. And then that way you'll have a better sense of how to craft your service to help the client address those items. The second one is to create an onboarding packet. This should include contact information, information about your company and what you expect of your clients. The third one is set expectations for in-person meetings, emails, responses. So essentially be transparent on your response time. The fourth one is to use technology to fill in the blanks. Consider using software or cloud-based applications for managing documents and accounting software integration. And the last one is always be open to feedback. Listen to what clients who express frustration on their own personal onboarding process and work to improve it. So while these are all geared towards accounting firm, I would say that most of these could actually be used on onboarding clients or customers in other industries as well. For example, some manufacturing companies have sent out welcome packets to new customers with a listing of products that are available, contact information to key employees within the company, or information on how to submit a sales order or payments and more. And then while this article has tips for onboarding a new client, I actually wondered if these items should be done as part of the proposal process in terms of landing a client. What are your thoughts?
Yeah, I think so. When I was reading this, it seemed as very much like check the box, like let's write an article kind of article. And my thought was exactly yours, Tammy. I was like, wow, I was really being introspective and thinking about how we onboard clients or how we kind of do that discovery phase and when we're selling for TCA. And I thought, man, this is all stuff that I would get before they would even become a client, and my thought behind onboarding a client is I should really know all these things that are there before we even accept them as a client. I don't want our first day to be spent with a client understanding their technology stack and how that's going to integrate and what we're doing. That's something that by and far. Now, if we were a tax firm, that might be different, right? Like, I don't care what your system is, give me the information, but we're not. And so I think to your point, I think it really, and if we're just talking about accounting here, it really depends on what the service offering from your firm is on how you would do this. But I also think that some of it seems very much like you're selling widgets or you're selling a commoditized piece of the accounting puzzle here, like you're just selling audit and compliance or you're just selling a tax return. And I think that industry in our sector is really well defined, but often, even though there's an RFP or request for proposal kind of, like flow of how you bring on new clients, often the referral process supersedes that. Hey, I know somebody can do this. You bring in the client. And there's not a lot of thought or care given around if they're a good fit for the firm, if they're a client you really want to work with. And I would like to see, I guess, from that side of, or more of the commoditized side of accounting, move towards more of a discovery phase that would give them a better idea if this is going to be a good client. Because, we've talked about on this podcast before, the 80-20 rule, where, 20% of your clients take up 80% of your time, and they're usually bad clients that you should fire. But I think you could have less of those 20% if you went through this in your discovery phase and understand better the underlying customer that you're bringing in. And so my list would be much different for onboarding a client. It would be introducing them to the team. This would all be, this list would be completed before we even sign them as a client. So my list would be different, where it would be, getting them engaged, getting them, getting that relationship built between who's going to be servicing that client and who's the point of contact, or who the people you're going to be working with in that client, letting them understand, and bringing them into that proposal process. Whoever's going to be servicing that client understands most of that stuff before we even get to that first introduction. So, I think it's kind of an antiquated way to look at it, but I guess if you got to have a checklist, that checklist will do, I guess.
Yeah, I agree with what AJ was kind of walking through there. And I think a different way to say that is that, we would see from our firm, we would see that what they're calling onboarding as scoping. And I think that, and I want to be careful here, because, AJ kind of mentioned it, and it is true for our firm that scoping with clients is something that we don't typically charge a fee for. It depends on the circumstance. There might be a scenario where we are adding a lot of value through the scoping process, and so maybe we might, but historically speaking, we do that kind of scoping work, which is, what they described as onboarding, we would describe as scoping. We do that as part of our sales process. But I don't think that's universally the right answer for every firm. I think that the reason that we do scoping as part of our sales process is because the type of work that we do and the client relationships that we're looking for have a pretty significant lifetime value to the client, or a lifetime value in terms of what that relationship will pay off in terms of, and they're high, to say it a different way, they're relative in our industry, they're relatively higher value engagements on the average that we're going through the sale process for. So basically, investing from our firm standpoint, investing in the scoping process, rather than making the potential client pay for it, we have found as a worthwhile investment. But I think that the economics, depending on the market that a firm serves and the kind of work that they do, that may not always be the case. It may very well be that if you're doing lower value services or lower cost services at lower rates and lower fees, and maybe the work that you do is more transactional and isn't anticipated to have a longer lifetime value to it, that it only makes sense to make the scoping exercise a paid for service, and so I don't think that's like, I wouldn't say that a firm that charges a potential client or charges a client for the scoping process up front is inherently bad. I would say it depends on their economics and their situation. I think that what I do believe is that there should be clarity that even if you're charging for the scoping, that's one engagement, and you're not committing yourself to the engagement that you're scoping until you have completed the scoping exercise, right? So I can foresee a scenario, like for us, that's not an issue, because like we said, and AJ was describing, we don't charge for the scoping exercise usually. So our client hasn't engaged with us at all for a fee or paid us at all until we are pretty sure about what the work is that we're going to be doing and what their business is all about and what our path would be in order to work with them. But I can imagine a scenario where a firm may very well charge for the scoping exercise first, and that's intended to take a certain amount of time, and that's a fee. And then once that scoping exercise is over, that leads into a longer or a bigger engagement that they were scoping for, and that's presumably a bigger fee, right? But my point for all of that would be whether you charge for scoping or not is a different question. But no matter what the situation is, whether you charge or not, you should always do the scoping before you jump into whatever your primary engagement is. There should be a scoping. And I think that's where we're all saying on this podcast, we see kind of a little bit of a weakness in this article in the way that it's framed, because it's talking about onboarding when, in our view, that would be more scoping that needs to be done before you get into your primary engagement, one way or the other.
Yeah, I agree with all of that. I just thinking about it from like a standpoint of if you're selling, like I know I've seen lawyers, for example, in the past charge a consultation fee because it's not always super likely that they'll land that engagement, and they want to be protective of the time that they know they're going to be outputting to all of these consultations. And in that environment, it makes sense because the likelihood of buying at that moment is maybe less than in some other environment where the client isn't as ready to kind of drop ship and go somewhere else. And so I think it's just a matter of being realistic with yourself as a service provider as to what that likelihood is that a person would drop ship and what you think the time horizon is on that engagement as a whole. And so for us, we look at it, like you said, as a long-term engagement that we're comfortable with. But if it were true that half of the people who came in and spoke with us ultimately went another way, we may, revisit that assumption. And so, yeah, I just think it's interesting to kind of think about how that decision plays out differently in different business models.
Yeah. The other thing I was going to say too, to add to Ty's point, in terms of if a company is going out for a bidding on any of the types of these services, whether it be the accounting services or auditing services or tax services, and you're doing, one accounting firm does the scoping or this process as part of their scoping process, I think they're going to stand out as being a little bit more of a partner or kind of working with the potential client, and a lot more transparent and informative than if they are going to another client that says, like, hey, just go ahead, here's the fees, here's this, and then, by the way, here's the information about us. But what do you need, or what are your service requirements are and expectations are after the fact. I think that if you're a firm that does it in the beginning, that you actually would stand out against maybe another firm that doesn't.
All right, everybody. Thanks for watching and thanks for listening to the None of Our Businesses YouTube show and podcast. Please tune back in again next week for more business updates from accountants' perspectives. And also please check out our sister podcast, Profitless on Purpose, where they're talking anything and everything relating to the nonprofit space. Thanks, everybody.
Bye.